get Jake on the call with us today. So that's always a challenge. Excited. Like just putting my 5 cents. Pretty pumped to have this product that we're going to talk through today live. As Matt was alluding to, it's been a journey. The product was live on L1 for a while, and now we've finally brought it to Optimism. So very excited to see the community use it. I'll pass over to you, Jake.
Oh yeah. Hello everyone. I'm a core contributor at dHEDGE. I'm mostly on the contracts team, and that's it.
Yeah, g'day everyone. I'm Matt, or also known as Taminator, on Discord, and that I'm community manager for dHEDGE, and just helping out with the comms and growth. Yeah, super excited for this integration. Yeah, we've obviously dHEDGE has been working closely with Synthetix since inception, and it's just really great to continue to explore the ways we can help the Synthetix stakers with this sort of debt hedging tool, especially now live on Optimism, which everyone's been screaming for probably almost 12 months now.
And maybe if we do a quick background of what dHEDGE is, for those on the call who might not be familiar, and apologise for my dog barking in the background. She's early here and she hasn't been out for a walk yet. So dHEDGE is an asset management platform launched in August 2020, and with very close ties to Synthetix, and it's now sort of expanded onto Polygon and Optimism, obviously, and has, I think, a current count about 1,300 different funds on the platform, run by over 1,000 different manager wallets. So the protocol's growing, and we're enjoying the ride, and excited to continue the relationship with Synthetix.
Awesome. Maybe you guys could just give a brief rundown of Toros as well.
Yeah, sure. So Toros Finance is an incubated protocol that dHEDGE launched we did a soft launch in sort of February, and then a more comprehensive launch a few months ago. It's a specific protocol for structured products and automated strategies that run now on Polygon and Optimism that tie in very nicely with the dHEDGE fund service. So there's different products, like there's leverage tokens. So you can buy, I'm in Polygon at the moment, one-click access to 1x, 2x, and 3x bear or bull tokens for ETH and Bitcoin. There's also some managed liquidity services where we can do managed concentrated liquidity on Uniswap for Ethereum. There's a stablecoin yield product, which is stable. It moves liquidity around specific stablecoin pairs on Optimism and Polygon. And now, obviously, the dSNX service, which we're going to get through today.
Yeah, awesome. So let's hop into the the meat and potatoes of the call, as we can call it. So let's talk a little bit about, on your side, how this your solution is able to automatically hedge against the Synthetix debt pool, and then we'll get I can talk a little bit on how users can actually interact with it.
Yeah, I'm Jake. Do you want to take that one?
Sure. So, what would you like me to explain, Matt?
Just explain what protocols that dHEDGE interacts with to make this possible, how they avoid utilizing debt pool assets for it as well.
Yeah.
Because just for context, when dHEDGE did a debt hedging pool, I think it was the first debt hedging pool. You're probably talking a year back at this point, maybe a year and a half back.
Yeah.
But dHEDGE's first debt hedging pool, what it did was it used synths to hedge. But the issue with that sort of implementation is that you're only exacerbating the problem of the skew of the debt pool, because you're just adding more assets long or
You're
short
taking
or
out more
whatever
debt.
it is at the time. Yeah,
You're
yeah,
trying to
exactly.
offset the debt by taking out more debt. Yeah. Yeah.
Yeah.
So the way the new, well, since version 2 of the debt mirrors work is that we use Aave to, you know, we either buy the assets that are in the debt pool. So if the debt pool owes 500 Ethereum, we buy 500 Ethereum. Sometimes what we can do is when we buy that 500 Ethereum, we can lend it and make some extra yield. So that's cool. And then sometimes if we need to short an asset, what we do is we use Aave to short it. So we'll buy that asset and then sell it immediately and get the capital back for that asset. So we'll have a debt on that asset. So this just mirrors the debts of the debt pool essentially. And you guys have provided us with an API that allows us to see what's, you know, in the debt pool at any particular point in time. And we just listen to that for events, and we have a bot in the background that trades on behalf of the synthetic debt pool account and buys the assets it needs to. So I guess at its core, dHEDGE is a set of smart contracts that allows for permissionless pools of assets to be managed by a manager. And then the manager can also delegate some behaviors to a trader account. So the trader account might be able to, you know, just trade assets, but they can't claim fees or anything like that. And for most of the people on the call, they'll know with dHEDGE, you always have the right as an investor to exit the pool at any time. So if you have some shares in the pool and you want to exit, you can just come along and redeem those shares for the underlying assets. Any other questions?
Yeah, that's probably mostly it on the side of the implementation. Let me actually share or rather pin a tweet that we actually just recently put out regarding how an individual user would actually use this solution. So pretty much what it boils down to is in the Synthetix staking app, an individual staker would they would go over to debt and then manage in the UI. There's links in the blog post that I just posted as well. And then from there, what a user would do is they would input the amount of SUSD that they would like to have hedged by the dHEDGE debt mirror index. And then they're able to just purchase into the pool immediately. It's as simple as that, as we like to say. We've tried to make this as simple process as possible. So it's just like a very simplified, like one-click solution to this staking problem. When a user wants to withdraw, they just have to head over to Toros.finance to do so. So that's really all it looks like on what a user has to do. We can probably lead into some questions about like how close the approximation is to the debt pool and things like that. Like, could you talk a little bit about that, Jakey? Like,
Sure.
Is it is it a perfect?
If we rewind a little bit, so when you come and stake SNX, right, you're essentially collateralizing. You're saying I want to take a position in the debt pool, and I'm collateralizing the debt pool with my SNX, and in return for doing that, you receive SUSD, which is basically the value of your assets. At the time you collateralize, given whatever the currency ratio is. So you get this SUSD, and then you can either sell that SUSD for something else, or you can exchange it for other synths, right? But eventually this SUSD comes back onto the market and it's used within the Synthetix ecosystem. And so if you stake SNX and you want to offset, or you want to hedge your debt, you take that SUSD that you've just received and you put it into the debt pool, or the debt mirror pool. And the debt mirror pool will go and buy the assets outside of Synthetix that are in the debt pool, which we covered a little bit earlier. Now, some of what the debt pool is the counterparty to can't be hedged inside the mirror. So for instance, you guys have futures markets, right? So you guys have like which are run on margin. So you can like deposit SUSD and then you can take out, you know, a futures position on, you know, S oil or something like that. Clearly we can't hedge these positions, so that part of the debt pool's debt is not hedged within the debt pool at the moment. If, for instance, there was some, you know, non-synthetic oil token on Polygon or on Optimism, we could potentially incorporate some of that into the debt pool as, you know, a hedge. But yeah, does that kind of answer your question, Matt?
Yeah,
Regards,
definitely.
you know, how
definitely.
accurate it is. So like normal assets. So for instance, a debt pool I know has some chain link in it. Like some people have some S chain link. So we hold chain link in the debt mirror. These kinds of normal assets, we can just hold. Anything that we need to short that's available on Aave, we can short. But yeah, there are some restrictions around it. So say for instance, you deposit some SNX, you take your SUSD, you deposit into the debt pool, you receive your debt pool tokens or your debt hedge pool tokens, dSNX. When at some point in the future, you'll say, okay, well, my C ratio's dropped. I actually need to sell some of my debt mirror tokens to get more SUSD to pay down my debt or to buy more SNX to stake more SNX to bring my C ratio back up. But at that particular point in time, you know, the dSNX tokens might not be exactly at parity to your debt. Because of futures and stuff like that, we can't completely hedge. The good news is the bulk of the debt pool isn't in these assets, so the hedge is pretty accurate.
Yeah, I think it's also probably important to note that an individual user, you know, probably wouldn't be able to hedge, you know, some of these exotic, or rather we can call them like long tail markets, unless they went off of Optimism as well. And even then, they may face, you know, some degree of difficulties. So the current status of dHEDGE's tool is, I would say, as perfect as you'd be able to make it yourself. You know, while understanding that there definitely are trade-offs on what assets are currently in Optimism.
I think it's also worth to mention that, like, realistically, these other like exotic positions you're mentioning, they make a very small part of the debt pool, and for the futures particularly, there's a funding rate which actually incentivizes people to take the opposite side of these trades and neutralize these markets. And the majority of the debt traditionally has been in the form of like outstanding ETH, either in the wrapper or like people longing spot ETH through our spot synth. So I feel like, you know, the debt pool pretty much. I mean, the debt mirror token pretty much captures like the majority of what it needs to like a pretty high degree. Like I don't know exact percentage what it would be, but like I assume it's pretty high.
Yeah, it just depends on like uptake of futures and stuff like that, and how large these markets are, I guess.
Yeah,
but as
and
you
like,
say, like
even,
there is incentive to try and balance out those markets, and then you've got the fees on top of that, so they may not need to be hedged.
Yeah,
for the most part, the futures are designed so that you don't need to hedge it. That's sort of like the sort of the selling point of futures.
Yeah, I was just gonna say, like, even with something like futures, you know, it's still part of a debt pool, so the debt pool, so you'd be able to get like the approximation of it. But if it was obviously a futures market like Ape or something like that, that's a different story. But yet again, very small parts of the debt pool that are completely okay to approximate, and that's pretty much what every other staker that I talk to is going to do anyway, especially with, like, when they're hedging. So,
I kind of had a question. Sorry, Matt. Before we move from this topic, I kind of had a question, a little bit more into the weeds of like how this. Well, I understand it, but like for the audience, basically, like when you say people put their SUSD into this pool, the pool is not actually holding SUSD, correct? Like it sells the SUSD into the market and then uses like other stable coins to to buy other assets, right? Could you just get a little bit into that?
Sure. So originally the dSNX didn't accept SUSD, but that meant that SNX stakers would have to swap that SUSD themselves to something like USDC. So what we did is, just to make things a little bit easier, is the dSNX now accepts SUSD. Once it hits the pool, like an event is triggered, you pick that event up, it gets swapped to, whatever assets we need to buy. So sometimes maybe there's an intermediary asset, so maybe it goes like SUSD, USDC, maybe it deposits that USDC into Aave and borrows some ETH, or buy some ETH or buy some Chainlink, or yeah. So yeah, it's pretty much just a nice to have feature of dSNX. It never holds any SUSD. It's just for deposits.
Yeah,
this is
absolutely.
Similar to like other pools, like other active managed pools. Like, managers might have, only BTC and ETH in their pool, but they accept USDC as a deposit asset, and then the manager just picks that up and allocates that within their mandate.
It's also probably like good to note here that that's not like a decision on dHEDGE's side as well. You guys probably go into that a little bit more too. But as of right now, SUSD is not enabled as collateral on Aave. So for all these interactions to work, you would need the stablecoin to be enabled as collateral. And even when it will be enabled as collateral, like SUSD, it is only going to have a supply cap of $10 million. I say only. That is a pretty good figure, but still, that's also like an important thing to note. It's not like dHEDGE said no, we're not going to use SUSD for any of this. They have to use USDC,
which is also kind of a good thing, right? Because as stakers, you kind of do want like SUSD to be available in pools where people can buy it and use it to trade and create fees and generate fees. So I had just one other question. Maybe like. Actually, this one I don't know the answer to, and I think the audience is probably wondering as well. When you buy and sell assets, like the automated bot, when it does it go through an aggregator, or does it have to swap through manually through different routes?
Usually goes through an aggregator.
Okay, cool. And is that like 1 inch on Optimism, or
1 inch on Optimism, UniV3? Depends what's configured. Depends where the best route is. We have a system.
So it doesn't just go out just so people understand.
So
it doesn't just go out and buy like in a liquid pool some ETH or something. It finds the best pricing for ETH.
So it can only operate within the contracts that are whitelisted within dHEDGE. So if you have like a pool on Optimism, a dHEDGE pool on Optimism, the dSNX is just a dHEDGE pool that operates within the boundaries of the dHEDGE protocol. So on Optimism, we support 1 inch, UniV3. I think that's it for as far as like swaps are concerned. And so it looks at the price of the asset, the Chainlink price of the asset that we're buying, and then make sure that we receive the correct amount. So we use the Chainlink price to set our expected amounts. So say we're swapping from like SUSD to USDC, we'll look and check at what the Chainlink price is, and we'll make sure that we're receiving an amount that's at parity. Does that make sense?
Yeah, absolutely. And by we, when you say that, like just for the audience, you mean like the bot that does it on the back end?
The bot that does it on the back end.
Okay, yeah. So I think an important thing to probably go into now is like what the future of something like this looks like. Are there any ways to make a tool like this, let's say, more capital efficient? Like if you could utilize something like leverage on chain or something, along those lines?
I'm not sure, to be honest.
Gotcha.
I would think is like you'd basically have to they'd have to whitelist like another leveraged like exchange, like something like per protocol on Optimism, and like if that gets whitelisted on the dHEDGE like protocol level, then they could essentially mirror and the liquidity is sufficient, they can mirror like the positions through that as well. Like I'm assuming, right? That would make sense.
Yeah, definitely. We've been looking into a few different options as far as future integrations are concerned. Perp's definitely on the list.
Yeah, and like just like this capital efficient question really comes more from like, maybe not having to deploy all of the assets, maybe utilizing some degree of leverage and then using some of the other assets to just like, farm with, on Aave or whatever, or in the stablecoin farming, like the stablecoin yield thing that is on Toros as well. So that's more of like where my question's going with this.
Yeah, so like I said, like a lot of the time with assets that we just have in the pool where we put them to work, so we deposit them and lend them through Aave. But there's no reason that if there are better markets to, farm on, we couldn't look to integrate those.
Gotcha.
If you guys in the Synthetix ecosystem find, a market like that, you're welcome to bring it to us and we can look at integrating it.
It is an interesting idea for a service though, like not just like this. I mean, this is a very pure one-to-one service to give people security that their debt isn't going to end up wrecking them when they go to unstake. But it is an interesting idea for a service where you could have like debt hedging squared, where it hedged your debt and also generated some yield for the hedger as well.
Yeah, that's pretty much like, where I'm going with that side of the question. But when it comes to the current Synthetix Debt Hedge, that's live and utilizes Aave, would there be a way to figure out like if there's any yield generation happening right now with the assets that are on Aave for someone? Like, if they're net positive by a little bit of APY from just, lending out assets?
Oh, we display the yield that each asset's generating from being deposited in Aave in the interface, but that yield goes to, as I understand, Jake, keeping the pool balanced with the Synthetix debt pool.
Correct.
Yeah. So it's not net positive, Matt. And when we try to replicate, well, the Synthetix interface tries to demonstrate that through the widget you've got on the debt page, where you can see the ratio of the debt tracking to the debt pool.
Gotcha. No, makes sense. Just kind of exploring, some interesting parts of this in my head. And as of right now, could you guys break down like the fee structure of this product, if there is one?
Well, at the moment, there's zero fees on both pools, on Polygon and on Optimism. So it's a free service for anyone who wants to use it. And that's the current state of affairs. There might be scope. I put a brief poll in one of our Discord channels on whether people would be open to a fee on it if there was some sort of staking returns that came back from people being in the pool, just as sort of like an idea. But as at the moment, it's zero performance fees and zero management fees.
Awesome. Why don't we take this opportunity to jump in a little bit onto like the dHEDGE side of things, the dHEDGE world, and less about the SNX. Why don't you tell us about like your fund manager? Sorry, guys, my microphone just died. So why don't we just hop into like a little bit about the dHEDGE side and like how the fund managers have been performing recently, or throughout its lifetime. And I see, like, I'm looking on your website right now. I see some of the top asset managers. They're more simplistic. But why don't we talk about a little bit like the more riskier strategies and like how they performed over time?
Matt, do you want to take that one?
Yeah. Can you hear me? Sorry.
We can hear you.
Yeah. I think there was some technical issues with my microphone before. Sorry, what's the question? Just about the active managers on the platform from like the beginning. Is that sort of the question?
Yeah, like how the managers have been performing, how you've seen them, like which funds typically get like the most attention, that kind of thing.
Yeah, for sure. Yeah, I think, well, obviously, I don't think not many people have been performing the last few months in this sort of recent sort of bear market. But yeah, in going into sort of last year, we had quite a lot of pools perform, quite significant total returns. Some of the bigger ones was like Convex Monster, who was quite big on going long and short on ETH and Bitcoin, and then just sort of holding US dollars to hedge in the sort of the downside. So he did very well, and I think his highest AUM was, I think, about 3 million at one point, and there was quite another. Just trying to think some of the other ones. There was another one. Jesse Livermore had a really big fund as well. He did really well. He was just pure like ETH, so just went into and out of ETH with the sort of market kind of swings.
So he did a more active trading strategy.
Yeah, he he just really looked at those swings when it changed sort of rapidly, either up or down. I think originally he tried to do some shorting with like the inverse tokens when they were a part of Synthetix, but just found they were a bit sort of inefficient the way they worked. So then just sort of changed to more just hedging into stables until the market sort of turned the other way and was quite successful in that sort of trading strategy.
But it's an interesting time on dHEDGE at the moment because we're seeing with the Optimism launch almost 6 months ago now, we're seeing some of the managers started to migrate their pools across from mainnet to Optimism for where they became inactive when gas prices sort of made trading on ETH a little bit not feasible from the volumes that these managers had. So we're starting to see that migration of capital go across to Optimism. So it's a really good time, one, for Toros to launch on Optimism so that we can start offering those automated strategies to managers on Optimism as they receive them currently on Polygon. But it's also an interesting time for these managers to sort of either start fresh with a new fund, or we're working on ways of retaining that manager track record that they've built up on mainnet and reflecting that in the front end for if they want to sort of keep the same name of the fund on a new chain. So we're looking at ways of doing that at the moment.
Yeah, that makes a lot of sense. And on that topic of Optimism and like sort of bridging these pools over, can you maybe go into detail? Like, I don't even know how this would work. Like, is like dHEDGE integrated with bridges where they could just bridge funds from one chain to another?
Yeah, no, it's still sort of a concept at the moment. And to answer your question, Millie, no, we don't use any bridges. But the current idea is that it would just be a front end modification, so that the front end would pull in the information from one chain and map it against the new trading activity, so everything stays on chain, but reflected through the front end in a way that looks as though it's seamless. But just to reiterate, it's still sort of a concept at the moment based on a couple of big managers that are looking to come across and wanting to bring that history across with them when they start on the new chain.
Interesting. And what is the process of adding new like whitelisted protocols to dHEDGE? Because I understand, like, realistically, like I'm sure most of our audience understands how dHEDGE works when you give a brief background, but I'll just refresh them quickly. Like, these fund managers, they have very limited abilities what they could do with these funds. Like, they could put them into protocols and they could take them out. They can't really do like transfer these tokens out. They're very limited what they could do just for security purposes, which justifiably so. So I'm just like curious, like how does the process of adding new whitelisted protocols work right now, and how do you guys see that developing over time?
Yeah, I can take this one. So generally what we look for is protocols that will give managers or Toros utility, so they're useful. And then we look at adoption of that protocol and look at the complexity of an integration. And so at the complexity of integration point, we look at how does this protocol work? Do they store the necessary information on chain? Do they expose the value of a position on chain? These sorts of things are necessary for dHEDGE to function. So within a pool, if there's an asset within a pool mixed with other assets, we need to be able to accurately value each of those assets within the pool. And so that's a really important part of being able to integrate with dHEDGE or dHEDGE integrate with a protocol. The other thing we need to be able to do is, up until now, we've always promised investors just-in-time liquidity. So if you want to exit a pool, we must be able to return to the investor their portion of the assets inside the pool. So this means there can't be any assets in the pool that are locked up. This may change in the future. We may introduce redemption periods for some pool, or there may be times where redemptions can't happen. But those pools that hasn't happened yet, and we're trying to avoid that altogether. We look at can we integrate? What's the value proposition of the protocol to the managers and to Toros, and then what we do is essentially the way our protocol works is we have these things called contract guards and asset guards, and we write a contract guard that pretty much just specifies what a manager can do on that protocol and who they can do it on behalf of. So usually just the pool, right? So they can only take out, an option under the pool's name, and they can only sell it back to the pool. As an example. And then the asset guard is, what I talked about before. How do we value that asset in the context of all the other assets in the pool? And then how do we return part of that asset's value to an investor if they want to withdraw from a pool? And so that, of course, we need to write those contracts. We need to test those contracts. We need to audit those contracts. And so this takes time. And you can imagine, we try and, get in front of protocols that we want to integrate. So try to start integrating them while they're in beta, or before they're released. So yeah, I hope that answers your question.
Probably the other important thing I'll just add is obviously this goes through governance as well. So we sort of would look at possible implementation from our side, or it could be suggested from the community. So we sort of see if it's sort of plausible. But then that would go through the governance process to make sure that is what all the DAO members feel is beneficial for dHEDGE and Toros.
Yeah, 100%. Thanks for those answers. And honestly, let me do some shilling on your behalf. Realistically, there's a very good reason why there's some cautious, why the protocol is cautious in terms of integrations, because for the most part, we see how DeFi is, can be not safe at times, right? And we've seen projects get exploited for lots of funds. Even sometimes projects, might not have a whole lot of funds. They might have less than 8 figures in funds, maybe only 7 figures, under 10 million, and still they would get hackers somehow find a way to breach it and exploit funds. Whereas dHEDGE has been live now for close to almost 2 years, and it's at the peak you guys had around close to around 40 million TVL. I'm looking on DeFi Llama right now, and still have a pretty substantial amount of TVL. And knock on wood, there has not been any issues yet. All the depositors have been able to redeem their funds whenever they want. Whether pool managers perform well or not, that's part of the system. But for the most part, dHEDGE has held up and has done what it's supposed to do, and there's not been any kind of a security issue. So I just want to give that shout out to you guys, and the cautiousness is warranted, I guess. So when you say that you kind of want to prioritize for protocols that allow for instant reclamation of their funds, so this would probably rule out any kind of project that has sort of a cool down period, correct?
Yeah, effectively that's the situation we're in now. And even, for instance, where at the moment we're integrating with Lyra, right? At some points in time, you can't close a Lyra position, or there's too much volatility. They have a few conditions, so we're looking at ways like how we best approach this. That's like heeding caution on like the investor side, basically. So yeah, it's so for instance, what's a good example? Like Ribbon Finance, we probably couldn't integrate Ribbon because they have deposit periods and then redemption periods. That wouldn't work currently within our protocol. Everything needs to kind of be atomic.
Right. I'm glad you actually mentioned Lyra because like I wanted to ask you guys about that, but it's interesting that you guys are like already looking into it. Of course you are. Like the thing with I'll just make clear for the audience, like when you mentioned that there's two aspects to delays in Lyra. Like there's one for like the LP who deposits funds into Lyra AMMs and like provides liquidity for these options. They are essentially they're locked in for an extended period of time, usually 28 days. And then also like the traders, when you buy an option on the AMM, if that AMM skews too far in your favor or too far against your position, there's like these bounds where it's no longer tradable until it moves back into like a more neutral position. And that's what Jake's talking about, where he says that.
Exactly.
Yeah. So there are these. I can fully understand your constraints. I just want to illustrate them for the audience.
No, that's awesome.
And yeah, just to echo your comments, Millie, appreciate the shout out to the security of dHEDGE. Just wanted to add in that the protocol's been fully audited twice in those almost 2 years, and yeah, zero funds lost in that period. So just to echo that comment.
And it's quite a feat, like from a user perspective, like, you know, it's a lot more complicated what dHEDGE is doing than just traditional like aggregators, right? Like a yield aggregator is essentially just taking funds and like automatically like depositing into a pool and it earns yield. Whereas with the dHEDGE, you're giving individual community members, people like this ability to use these funds like that are deposited in their pool arbitrarily, not fully arbitrarily, but like in terms of like from a speculative or trading perspective, kind of arbitrarily. So I think that like is quite a feat, and it's not like easily reproducible. And obviously, like I don't even think dHEDGE has like a lot of competition. Do you guys have any competition on that level?
Not really in the active management space. Like as you said, it's a tricky thing to try to implement. There's competitors in the index token space, for instance. Like if you look at a fund as a static ratio of assets, then you could include index tokens as a competitor. But from a purely active management space, then it's fairly unique.
Was it you, Millie, that I was talking to about dank pools?
I don't think
on the call last week.
Oh wait, on the off? Are you talking about the office hours?
Yeah. Like, the unrestricted pools.
Yeah. Do you want to maybe go into that a little bit now?
No, just on our community call last week, we were talking about having. One of the issues we have at dHEDGE is that managers can't move quickly into new protocols because we need to set up infrastructure within our contracts to allow it. So we need to write this contract guard, this asset guard. We need to understand the protocol. We need to understand how to value those assets. All this kind of stuff has to happen. And sometimes what this means that, managers miss out on being early to a protocol and earning really good rewards. And so we've discussed internally having certain types of pools have less restrictive boundaries. So, being able to use protocols unrestricted, but you still using the dHEDGE framework or protocol for managing investors, but without those investment restrictions. So like a free mandate. This introduces much more trust into the scenario, but this may work for some managers who are managing money on behalf of, some people they know or something like that. They just want to use the tooling that dHEDGE provides as far as, fees, distributions, allocation of capital, allocation of shares, this kind of stuff. Yeah, that's it.
Yeah, I mean, there's a lot of like on a conceptual level, like you could probably think of so many different, ways to get, get do some interesting stuff. And like, I honestly think like, I like the pace you guys are going on. I think it's appropriate, and I'm pretty excited for like where it goes. Like I remember when dHEDGE first launched, even just the UI has improved like tremendously. Like I'm sure you guys done so many optimizations you guys worked on. Probably can't get to like everything on the call, but like I mean, there's been a lot of improvements over time, and it's just been steady growth in my opinion. Even though like the TVL goes down, but that's mainly a factor of like the asset prices in the pools like ETH and Bitcoin and different stuff, which have declined over time. But
yeah, I guess just to readdress the point about teleporting funds from pools on one chain to another, it's actually quite a tricky operation. Like of course, like these pools are effectively contracts with addresses. They have some storage that records like who owns what. It's very hard to teleport that kind of storage across chain, and so anybody that's familiar with how bridges work will understand that like it's one thing to teleport one token across chain and settle that, but it's quite another thing to try and teleport the state of an entire contract through a bridge. And so at the moment it's more of like a manual, like investors have to manually transition their funds from pools across chain, and this also means that it's much more secure, where they can use the bridge that they're familiar with. We don't introduce any bridge risk into our pools, and that's kind of been discussed pretty heavily within dHEDGE, like the value proposition of trying to create some kind of like pool bridging system. It's just not there yet.
Yeah, and I would kind of agree with that, because realistically, like, bridges in general are quite risky. Like, I know most of the people that I know that are really smart and understand DeFi well, they sort of, say the same thing, that like realistically, bridges right now, the current the current technology around bridges is still not like proven to the degree they would like. And so there definitely is that sort of like that risk factor. Matt, do you want to maybe turn it over to the audience for some questions at this point?
Yeah, definitely. If there's anything from the audience, raise your hand. Also, if you can't raise your hand, or if you are on your laptop or something, then you're not going to be able to speak in the call. But you could also just DM me or anything like that on Discord, or go into our GovCall chat on our Discord, and put any questions there.
Yeah, let me take a look in our GovCall chat actually.
What's happened with the Synthetix teleportation? I remember there was, I think is it SIP 205 or 204? I think
Yeah, so realistically, it's quite a complex. Like on the same point that we were just talking about, like just bridging and cross-chain stuff becomes really tricky on a protocol level, and it introduces a whole different like risk vector. And so Synthetix is very cautious right now on how they approach that, even though like it is very much feasible. It's just how they go about it, and realistically, like. I think that the roadmap at this point is to basically wait for Chainlink to introduce their cross chain messaging protocol, and sort of go off that, because Chainlink has like this proven record of being, quite rigorous in terms of testing and safety. Although we had that Luna incident just recently, which was was interesting with Chainlink, unexpected. But yeah, I mean, for the most part, I think that's the sort of the route they're taking. The core contributors have been thinking about.
Yeah, Millie hit the nail on the head on that one. It's a question of risk and all these other things, and at the end of the day, Chainlink is an infrastructure provider and has done a fantastic job at it. So leaning on them for the future of something like this is probably a better path to go for the Synthetix community and stakers and so on and so forth. Because if there was some sort of issue, the debt pool would have to back it, or something like that would have to happen. I don't think stakers want to be in that position. But we actually do have Jeff, who wants to be a speaker, so let me pull him up.
While we're waiting for Jeff, I'll just say the dSNX token's been it's been pretty well received so far over the last 3 days since launching. I think the pool's totally already hit 80 unique wallet investors from L2 stakers. So that's a pretty good result from such a short day of being a short duration of being live. So shout out to everyone on the call who has got involved in that token already.
Yeah, it's like second highest on. It's the second highest TVL on Optimus right now. By just a small fraction too.
Another interesting point I'll make up is the SNX debt mirror that we launched on Polygon last year has almost been one of the better performing pools. So obviously the global synth composition is a pretty good indication of what is happening in the overall market at the moment, just as a little side note.
Well, that's an alpha leak. Yeah, that's a good point there. That's an alpha leak.
There's actually a pretty big alpha leak that Matt is actually missing, which if anyone had been in the Matt Pro Trader Fund back when we launched the trading competition with dHEDGE back in the day, they, would be. You're not going to say the word in the green because
are you top 10, Matt?
Dude, I am number one all the time. Okay, I actually have no idea. Just to provide context to everyone on this call, I made a pool on dHEDGE when we did a trading competition, and I didn't do any trades during the competition, and still haven't done any trades to this day. And that was back in like November or so. Like December. So that's a very high performing pool because it has 0% returns in a market that has, taken a little bit of a beating. So I actually am going to go check on that pool in a second, but I'll pass it over to Jeff.
Hey guys, how you doing?
Pretty good, man. Happy to have you here.
No, thanks for having me. I'm just curious in regards with the smart contracts and the cost of that from the difference between layer 1 and layer 2. What's I guess the difference with the cost with us transitioning? Well, we're obviously on Optimism now, but what's the overall sort of cost differences between layer 1, layer 2 to grab your rewards?
Is that a question around gas fees? Yeah.
Yeah, gas fees. Yeah.
I think at the moment to do a transaction on Optimism using dHEDGE, it's around 50 US cents. I think just if you bring it back.
Yeah. Right. Okay. Yeah, that's massive. Yeah, because it used to cost. I mean, on layer 1, it's an average $40 to grab your transactions. When we obviously when we're fully layer 2, the question is, will that be a smooth transition? Will that be like a will we have to do anything, or is it just going to be automatic?
I think at the moment, just to clarify, you can have you can stake. Is it a synthetic staking question, or is that using the D?
Oh, okay. Yeah. So I can hop in on that. So
sure.
You're pretty much asking. Yeah. Thanks, Jake. You're pretty much asking when staking is transitioned fully to layer 2 at some point.
Yep.
Will there need to be any sort of intervention by the actual user?
Yes.
The answer to that is I'm going to say yes, but also all of this pending, governance action. And just so you know, like none of that has been drawn out yet, or there haven't been any comms on it as well.
Okay.
So if you'd like to, burn your debt on L1 and transition to L2, you can. But you can also wait on debt migration, and once that's prepared, and I think one of the key roadblocks has just been passed. Some of the final test with the SUSD bridge to allow SUSD to go from L1 to L2 and then L2 to L1 back in a completely fungible way Some of those final tests are just being completed. So that's
Oh, cool.
I'll refer to it as the path to debt migration. But
Oh, cool.
no timelines on any of that as of right now.
Thank you. All right, thank you guys.
Yeah, no problem.
Yeah,
at all.
and just to add to that, just to be really direct to your question, like there will be when debt hedging, when debt migration goes live, as Matt mentioned, you will have to do some interaction. It'll be minimal, and the whole point of it is so that the user interface for it is very smooth. And so, like it's as simple as when you go to claim every week and you fire a transaction, it'd be similar to that, where you just you fire a few transactions and you're migrated to layer 2. So it will be very smooth in that sense.
Yeah, that is it's a great point for Millie as well.
It's an interesting question though, from the fact that does having automated hedging now on L2 make the two experiences now similar, as in staking on L1 versus staking on L2? Like, are there any differences anymore in sort of the features you have access to?
Yeah, so pretty much the difference between staking on L1 and L2 would just be the amount of fees that you would get from trading, and then the amount of fees that you would get for inflation. So just to go into that, you receive trading fees based on the chain that you're on. So if you're on L2, you would get trading fees from futures and things of that realm. If you're on L1, you'd get it, from the same set of like synth swaps and atomic swaps and things of that nature. So that's the difference in, how fees are distributed. But outside of that, also you get a different amount of inflation, a different ratio of inflation based on if you're on Optimism or Ethereum mainnet.
And liquidation rewards as well, I suppose.
So when it comes to liquidation rewards, what was done most recently was when liquidations were done on L1, there was a lot more that were done on L1. The rewards were distributed to L1 stakers, and then they were actually the rewards that L2 stakers were entitled to were bridged to L2. So not really. Liquidations is kind of the I'm going to call it like the black sheep of this equation, because when it comes to liquidations, everyone, is assigned debt pro rata, like instantly, but some of the rewards take a little bit longer because they have to be bridged from L1 to L2 or L2 to L1, depending on what chain has more liquidations occur.
Is it worth going over an example of like an SNX staker when they don't hedge their debt at all, just holding SUSD? I'm sure you guys have a million examples of this happening over the past few years in Discord.
I could tell you.
I was actually just going to pass it over to Millie. But yeah, Millie, go for it, man.
Well, it could be rough, right? Like it could be very rough, and it's happened in many situations where the debt pool will move against you. Like you mentioned yourself, the alpha leak you gave. And I'm looking at that Polygon debt mirror token right now on dHEDGE, and in the past 6 months, it's up 23%, and compared to like everything else in the market, which is basically down. The entire crypto market is down, and so, like you said, like the people who are, holding synths, they definitely know what they're doing to a sense. And so if you're not hedging those positions and, the SNX price is moving against you, and let's say you're holding ETH, for example, or like you're long certain assets, or like, you're not hedging fully and you're just like, holding other tokens, you can get, you could definitely put yourself in a tough situation. Like I have, like myself, and I have been very poorly managing my debt over the years. And it's been costly for me, but yeah. So like realistically, it can be an issue. And like you mentioned, again, back to Alpha League, that debt mirror index has been quite a good indicator on like how the market is moving. And if you're not hedging, it usually moves against you, and so it has a double effect. But realistically, if you just hold stable coins, I mean, you probably wouldn't be down a tremendous amount, but again, like you would be underperforming to some degree. Except for when like the debt pool is wrong, which is doesn't happen too often on a long time scale.
Yeah, I think there's probably like a good way to look at this where for a long time, at least this is probably going back 2 years ago, the Synthetix debt pool was very long Ethereum. Probably go back even further. The Synthetix debt pool was very long Ethereum. So what happened is if some users maybe just forget to hedge in general, as ETH went through its run up up to something like 4,000 or so, those users were what I'm just going to pick out numbers, but let's say the debt pool was 70% along ETH. That introduces a pretty large problem for a staker who just saw ETH go from a couple $100 to $4,000, and they didn't do anything in the interim. So using a solution like this from dHEDGE saves you from something like that, and allows you to be a lot more worry free when it comes to staking.
And to Matt's point, also there was like a point where BTC had a huge run up, and the debt pool was like largely consistent of BTC, and like unless you were holding wrapped Bitcoin, like you were. Your debt was suffering kind of, but the only thing was that like SNX price at that time was sort of performing really well too. But like in the events where SNX price doesn't it's flatter or it doesn't perform so well, you could definitely be in some trouble. So the debt mirror index token is definitely very useful in that sense.
So I guess Millie, a good example is say you staked 6 months ago and everything else remained equal, so the SNX price remained the same. You were saying like the performance of the dSNX is 23%. So if you weren't hedged, you would now be down 23%. You would need to make up that 23% with your own funds. But in the case of if you had have invested in dSNX, all you do is you take some of your dSNX, you sell some to get that extra 23%. You get your SUSD, and you burn some of your debt, or you buy more SNX and you stake. So you sell your dSNX, you get SUSD, you burn it, and that will reduce your debt, and then you're basically equal if everything else remains equal, like the SNX price and stuff.
Correct. And even if the SNX price goes down, like what you would do, like what you just mentioned, is you would just incrementally sell the debt mirror index every week when you need to claim. And so that way, even as the next price goes down, you're debt hedged, you're fully debt hedged. And so you essentially just burn your debt and you continue claiming, and your C ratio remains stable. So yeah, I mean, even if SNX price were to go down, you still would benefit from being very well hedged.
Yeah, all very important points. And there's probably people that you could look at, like Kane, who just put on their Twitter recently that they were that he was selling large amounts of other holdings to bring himself back up to 300% so he could claim. So it happens to everyone. It's not like this is something that only new users are going to utilize. I can tell you that I'll personally be utilizing this feature. But yeah, so this isn't just like a new staker problem. Sometimes people just get a little greedy and they start using their debt for other means, or they speculate with it, or whatever they do. They try to beat the debt pool, which people can still do, but this just introduces another option for people to utilize.
I think it's easier said than done, isn't it?
Absolutely, exactly. And I just want to make one other point, but like I want people to understand that a 23% increase in debt, when the debt mirror index token, I mean, to replicate that with stablecoin yields, over 6 months, you'd have to be earning, close to 50% APY on your stables, which is, it's just, you can't find that right now in DeFi, right? So it's not a safe haven just to be in stablecoins. To protect your position, you really need this tool, and it's just a huge bonus for Synthetix that it's finally live now. Like it's live on Optimism now.
Yeah, I was gonna hop in and say, if you can find 50% stable yield in those good farms, toss that stuff out there on Twitter. But 100%, I
that's safe and not some rogue.
Yeah, that's the next part of things. Find a stablecoin farm that follows the philosophies of dHEDGE and making sure that I can exit it when I want with the amount of assets that I started with, plus the yield. Then I'm happy. But you're asking for a lot in this little checklist I've developed. So, but yet again, you know, I tell everyone on this call to check out the Debt Mirror Index. It's super easy to use, and it's, you know, it's going to be a tool that I think you know, many stakers are going to love to use and will rejoice with now having it. I really can't wait to look back, you know, in a couple months and like see, you know, how many individual users have used it and what the TVL looks like at the time.